Welcome to this episode of Market Squawk India. Today I'm going to be teaching options. So options is a part of derivatives and derivatives comes from the word derive. So there are options, futures, forwards and OTC market strategies. We are only going to focus on options right now. So an option is always given to the buyer. So the buyer has always the option to exercise it or not. So think of it this simulation as Yes Bank. Say Yes Bank is somewhere at 40, 45, and we are bullish that Yes Bank will go higher. So we'll take a strike price at 50, and at 50, we are supposed to pay a premium because we are the buyer. So whoever's going to buy something obviously has to pay something, right? So that premium, let's say it's 10. This is just a simple explanation. So once Yes Bank crosses 50, you can see the derivative always follows it. Think of it, the derivative as Aladdin and its magic carpet. So the stock is Aladdin and the magic carpet is the derivative. It's always going to follow Aladdin. So because it's the underlying asset, so if Yes Bank crosses 50, then now we are in the money because now it has crossed your premium also. So the total you need to achieve above 60. So if you take it on a profit basis, as long as it's below 50, it's not going to be good. So once it crosses 50, the stock price, we are going to actually achieve profit. So this is it when you combine the graphs and look at it. And we are going to be in the money as soon as it crosses 50. When we are crosses 60 will be our intrinsic value. That means how much we're going to make because we're covering our premium cost also. Now call option payoff seller's perspective. Now we want to sell the call option. So if you're going to sell the call option, we're going to get a premium now. So as long as the stock price does not converge below it, we are good because we have now got the premium of 10 rupees to hold. We are still bullish that the stock price is going to go up. So once it crosses 15 goes above, you can actually make money and keep the premium, which is a small amount. But historically, net option sellers have been in making money basically. If you use it with data and certain analytics of probability, you can make money in the options instead of hedging it versus your stock price. So this is now a call option payoff seller's perspective. So we again wanted to, be below 50 graphs. So when we buy the put option, we are now bullish that the stock price is going to go down. So again, once it crosses, yes, say Yes Bank goes below 50, we now have to cover our premium, which is, it has to now cross 40 before it makes some money. So that is that, and the combined graph looks like this with profit and time versus expiry. So this is covered call payoff diagram. It's nothing but the same thing which I've just spoken earlier. Your covered call is basically when you buy an underlying also, that is Yes Bank, you actually buy the stock and you cover it with a long derivative also, a long call. Long is buy, short is sell. So when I say long call, I am going to buy the call option. You can take expiries of 1 month, 2 months, 3 months at the most. Some index options also trade on weekly basis. So it depends basically. Yeah. So that's it. And there's something known as a straddle. So we'll basically use a long call and a long put, and we'll issue it in such a way that it has to get out of these lines. Either the stock goes up or goes down when volatility is on the upper scale. If volatility is very high, Then instead of a long straddle, we'll use a strangle where it's closer to the strike price is underlying. So basically, yeah, and derivatives are options are American, European, and Bermuda. So basically, India we have American options. So that's that. This is a complex product. It's not to be understood now. And thanks for listening, guys.